and listen in. What you see on the screen, you probably saw, Multiplier 101 was what we kind of titled the invite. And I think about the IUL marketplace in general. And when you think about the IUL marketplace today, multipliers are a pretty common feature in almost every IUL out there in different forms and fashions. I'm going to talk a little bit about that as we go through, but I just wanted to kind of start out by, talking about how IULs are a lot like, anything else that somebody might purchase out there. There's a lot of different features and benefits to every different one, and understanding what you're getting when you buy each different product is really important. It's important to you, it's important to your client, and, really taking a good hard look at what's out there. And, just like, vehicles have changed through the years. If we looked at a 1950s Ford, that'd be kind of relatable to, life insurance back in the 1950s. Pretty basic concept. You paid for it. It was a vehicle. It got you from point A to point B. Life insurance is a vehicle as well. It's a financial vehicle meant, initially you pay the premium, you get a death benefit. But just like vehicles, life insurance has evolved through the years. And, today's life insurance products that are in the market have a lot more features, a lot more benefits to them than, the ones of the early 1950s. And when you think about the life of your client, they're on a journey. They're on a financial journey throughout their life. And every time we take a journey, we also run the risk of having an accident. And this isn't any different with financial. There's financial accidents that happen to our clients on a somewhat regular basis. And the great thing about life insurance policies, just like vehicles of today, is there's a lot more safety features built in. And those safety features, can allow your client to walk away from that financial accident, just like safety features allow you to walk away from a vehicle accident. So, when you look at IUL today, and just life insurance in general, with living benefits, but in particular the cash value that you can accumulate or that your client can accumulate, provides you that safety net or that safety feature, whether it's a seatbelt or an airbag, to be able to potentially walk away from a financial accident. Because we think about the different ways that life insurance policy can be used. So they could take a loan against the policy, they could take a withdrawal, different things to help support them in a time of need. And then when you start talking about living benefits, with Global Atlantic, we have our accelerated access rider, but with living benefits, for chronic or critical illness, that can be a great financial accident for one of your clients. And if they're not prepared and have a vehicle to help support them during that time with the right safety features, that can be a terrible financial accident for them. So it's really important to think about what's really involved in the product. So as we kind of dive a little bit deeper, the one thing that I can tell you about this market, I've been in financial services market for over 20 years, and I've worked kind of across the spectrum. And the one thing that I'll tell you, if you're new to this market, is the only thing that's constant is change. I know we've all heard that. People say that probably about everything, but financial services is definitely one of those places where things are constantly changing. If we look at products that were launched or updated in 2019, there were over 30 new or updated IUL products launched in 2019. So either a brand new product by a carrier or they updated their product in 2019. And over half of those were released during the fourth quarter. That's a lot of change. And for you guys as producers and agents out there, that's a lot of information to be consuming and keeping track of. So the IUL market in general is the fastest growing segment of the life insurance marketplace. Overall, the life insurance market, when you look back historically, it's been pretty flat. But the IUL market has been averaging about 7 to 9% growth when you average it out over the last 10 years. Whole life still continues to be the top selling overall product, but IUL continues to gain more and more market share. But, with January 1, we had some major changes to the life insurance industry. Every product that's out there had to update their product to comply with the 2017 CSOs. So Commissioner Standard and Ordinary, to comply with those requirements. Those requirements made changes to the products that impact the products that you're selling today. So we're going to spend a little bit of time talking about that and how that has affected product design. In particular, multiplier products. The other thing that we see constantly changing is, caps and participation rates depending on the product, and how that really impacts a product's competitiveness, as well as, what is your client really getting? So I want to talk a little bit too about, caps and participation rates. What really influences that within an IUL? And when you think about multiplier products, to really break it down simply, it's almost like having two different index strategies within the same product. That's a little bit of oversimplification, but caps and participation rates are very important, and it's important to understand what's behind those caps and participation rates, how carriers set those. So we're going to spend a little bit of time around that and what's happening in the current market today. The IUL value proposition in general, people have always talked about zero is your hero. IUL gives you upside potential with downside protection, but the new product designs that have been introduced over the last year plus are really creating a different value proposition for that IUL client. And that's where the multipliers really come into play. And we're going to spend a fair amount of time talking about the multipliers, looking at the mechanics behind it, as well as what to be watching for when looking at product designs. And then finally, I'll kind of wrap things up at the end, going into Global Atlantic's version of multiplier product, which is our Global Atlantic's Global Accumulator IUL with smart buy-ups. And we'll talk about that and some competitive advantages that we believe exist within that product. So I understand the sound quality is pretty poor. So I'm going to try to switch what I'm using for phone and see if that improves. Okay, so if I can get if anyone wants to type in the Q&A on the sound, did that improve the sound?
Sounds a little bit better, Donald.
Okay. I see from someone else they say no, not better. I'm just gonna hang up and I'm gonna dial back in and see if I can improve that.
Thank you for your guys' patience. We're going to try to get the audio situation taken care of. I know it was kind of initially it was down a little bit, got a little bit better, then it definitely kind of plateaued at that end there where it was a little bit tough to hear. So we're going to try to get Donald logged in a different way to get that sound quality sounding a little bit better for you. So we appreciate the feedback. Apologies about the short delay, but we'll be up and running here very, very quickly. Thank you.
Okay, I apologize about the sound. Kyle, is that?
Yeah, that's much clearer, much crisper. Thank you, Donald.
Yep, I apologize everyone for that. So just to recap quickly, what's on the screen here is kind of what we're going to run through. I want to talk about the impact that 2017 CSO had on the products, and what that really means and what that means from a product development standpoint. talk about the caps and the participation rates and what really drives that, why carriers are making changes right now, and things to watch for as you continue to sell IUL, because it's important to understand how that actually works. With the new product designs that are out there, the value proposition of IUL has changed greatly. So multipliers have introduced, new risk that didn't used to exist. IUL value proposition was always upside potential with downside protection, where new product designs took that zero's your hero away and now have introduced potential downside that didn't exist before. And then finally, I'll close with some competitive advantages of our global accumulator IUL with smart buy-ups and talk about how we've positioned that and why we built it the way we did, and how we think it really competes in this multiplier market. So with the 2017 CSO, what does it really mean? I mean, you guys, people have probably heard, 2001 CSO, 2017, and every contract had to comply with 2017 CSO January 1. So what really happened is the NAIC looks at it in Society of the Actuaries, and they look at life expectancy. So people are living longer. That's a great thing. What that means for insurance policies is the cost of insurance rates in general are lower on products with 2017 CSO because of greater mortality or improved mortality. So for death benefit guarantee products, we've seen, that has a positive impact on the guarantee premiums. On accumulation products, the max funded scenarios, what that really means is your MEC premiums are lower. So if you were running the same face on an old 2001 product versus 2017, you're going to see a lower max funding limit. If you use the same premium between those two products, you're going to see a higher initial face on a 2017 CSO product. Now you're probably saying, well, wait a minute, on death benefit guarantee products, premiums aren't going down, they're going up. Well, that's due to some other market impacts that I'll talk about here in a little bit. But in general, when you think about the actual cost of insurance, the per $1,000 charge, because of better longevity, that in theory would help those death benefit guarantee products if it wasn't for other market factors. Interest rates is what that factor is, but we'll dive deeper in that in a little bit. So the impact that this had on case designs was the same face amount equal to lower max funding limit, which showed lower illustrated distributions. So if the carrier did nothing to their product, if the only thing they did was update the mortality table in the product, they would show lower illustrated distributions just because you can't put as much money into the contract for the same face amount. Same thing would go on a minimum increasing death benefit solve, which is what most people do when they're showing distributions. That same premium is going to result in a higher initial face, which is going to have an impact of lower illustrated distributions. And let me show you kind of on the mortality curve what I'm talking about. So what you see here is deaths per thousand. Deaths per thousand, and it ranks it from, so you've got the 1958 CSO, which is the dark blue line at the top. You have the 1958 here, then you've got 1980 CSO. The most recent CSO table that life insurance products were based on is this one here, the 2001, and then all products now must use the 2017. So what you see is better mortality, so fewer deaths per thousand by age. So that has an impact on how much premium you can actually put in, because the better the mortality, the lower your MEC premiums are. So if you noticed with any carriers who just, the only change they made to their product was moving from 2001 to 2017 CSO, and you compared two products, what you'll see is those MEC premiums are actually lower on the 2017 CSO product. That makes a difference because that starts to impact the actual costs that are in the contract through the net amount at risk. So I talked about, what the guaranteed type products, and while the CSO, the 2017 CSO update improved or lowered the kind of COIs because of the better mortality, what you see here is the Moody's corporate bond rate, looking back over the last 10 years, and looking at those interest rates, because the insurance companies, as insurance companies, we have to invest in high quality fixed income. The majority of our assets sit in high quality fixed income. So a big part of how we provide for guarantees is based on what we can get as a return on our assets. This also goes into play when we talk about how much money we have in our option budget to pay for a cap or a participation rate on an IUL. And as interest rates have gone down, our ability to earn a rate of return or a higher rate of return with those fixed assets has decreased. So that budget, or the amount of money that we need to reserve or hold back to pay for the guarantees in the products, has increased, because we have to hold back more, because we can't generate as much of a return at the lower interest rate environment that we're currently in. Likewise, when we talk about cap rates, participation rates, when you think about the money that we are charging within a contract for the option budget, and that return that we can get on that option budget, that has decreased as well. So that option budget that we have within the contract has been decreasing at that same time as well. So this is why you see carriers making changes to their cap rates. The other thing that influences the cap rates, though, and participation rates, is the option cost. Because as you know, within an index universal life contract, you're not actually invested into the index itself. Instead, the insurance company is going out and we're buying options. So we're buying an option from an option broker in order to provide that cap and that participation rate. What I have on the screen right now is the volatility index. The volatility index directly influences the cost of options. So the higher the volatility, the higher the option cost. So right now, the environment that we're in, we have a lower interest rate environment, which means a lower return on the portfolio for the carrier. We have a higher volatility market, which means higher option costs. Now, thankfully, volatility has dropped down into the upper 20s over the last few days. So this slide is, it's a little bit out of date, because it was a little bit earlier this month, but we've seen volatility come back down, but you can see it spiked there right after COVID. So, between the mix of the interest rates and the volatility, we're seeing a lot of pressure, for what carriers can offer from cap and participation rates, which is why you're seeing a lot of them change right now. These types of things also influence product design. When you think about index universal life and, what impacts it and what to watch for, when you see high market volatility, low long-term interest rates, that's kind of the toughest time for index universal life. Over on the right-hand side, high long-term interest rates, high market volatility could have a positive or could have a negative impact on index universal life caps and participation rates. Really, the best case scenario for index universal life is high long-term interest rates and low volatility. If we see both of those things, what you'll see index universal life caps and participation rates increasing, carriers offering, higher cap rates, higher participation rates. So those are the factors that really go into influence when a carrier is developing a product. So in order to kind of offer additional potential, carriers introduced the multipliers. because what the multipliers are doing is they're charging an asset-based charge, and we'll go through this more in depth here in a minute, but they're charging an asset-based charge to provide a secondary option budget to be able to buy that additional cap or participation rate to provide additional upside potential for the client. So if we think about the IUL value proposition as it exists today, you know, the traditional IUL value proposition was what you see on the screen. You have the market up and down, but you have a cap rate. So you have a cap and you have a floor. So, you know, you're giving up some of this upside potential here, but you're protecting yourself from the downside. But with the new product designs, the way they initially kind of came out, everyone thought that a multiplier, that this is what it did. It just took, and if you had 100% multiplier, you were going to double whatever your index participation was or your index crediting was. But the reality is, it really becomes this. It now is created, you get additional upside potential, but now you've created this downside risk for the client that didn't used to exist within a traditional IUL. So multipliers are a great innovation within the index universal life space. But it's important to understand that with that innovation or with that product design, that additional risk that it brings for the client that didn't exist in the previous designs. So it's really important to understand that, but almost every multiplier that's out there that has an asset-based charge, what you see on the screen is really what you're getting and what you're exposing, what the client's exposed to. And if you wonder why the green line slid down, the green line slid down is because you have an asset-based charge. So you still have a net upside that you have to take out. We'll walk through an example here in a little bit, an actual numerical example, and kind of show, and then also show how our product works. So it's really important to understand what's under the hood of the vehicle that your client's buying. You know, traditional IUL without multipliers, your index option budget buys you a cap and a participation rate. Those caps and participation rates are going to be influenced by interest rates and volatility. That's really going to be what drives what the cap and participation rate is. Within multiplier and buy-up strategies, you still have your base or your index option budget, your base budget, just like in your traditional IUL. But now you've got an additional option budget that buys another cap and participation rate. The cap is usually tied to whatever the base strategy is. The participation rate is really your bonus. And the way that that budget is created is by charging an asset-based charge to the account value that is allocated to that option. So the asset-based charge goes directly against the cash value that is in that index strategy option. So that's where it comes out. So as that bucket grows, that asset-based charge is a percentage of that account value in almost all designs that are out there in the marketplace. But when you think about it, bonuses, multipliers, enhancements, they've been in almost every index universal life design that's been out there since they were introduced. The first one, the one that's at the top there, is a flat rate bonus or enhancement. We call it an account value enhancement at Global Atlantic. But the way that one works is it's a fixed rate multiplied by the account value equals the bonus amount that's applied to the contract. These vary. Ours starts at the beginning of the 6th year. A lot of carriers start them at the beginning of the 11th year. And it normally applies to the full account value, both the fixed and the index strategies. These are built into the core product. It's not an additional asset-based charge. It's just a function of the product. These are nice because even when your index return is 0, you're still getting an additional enhancement because you're taking that flat percentage multiplied by the account value. So these are a nice enhancement, a nice benefit within a contract. You want to look for these, look to see that they're guaranteed. There are a lot of different variations on this, different amounts. They range anywhere from 50 basis points up to 125 basis points. They vary from starting at the end of the 5th policy year up to the end of the 10th policy year. There's a couple of carriers that have a non-guaranteed one that starts in the 2nd year. But these are nice because it's that additional bonus, automatically built in. There's not a separate asset-based charge for it. Just goes directly to the account value, or the account value. The percentage multiplier bonuses are a little bit newer. These sit out there. They provide additional credit based on the index value. So the value in the index. So it's 1 plus the multiplier times that index credit gets the total index credit amount. Now, these only apply to index strategies. There are some carriers that have these built into their base contract at no additional cost. And the multiplier is most common. It's 15%, so 15 basis points. You can see that one at the top. This is typically offered instead of the kind of the flat rate bonus on the account value. And then it's just added to the index buckets. So you can see in the example, to get, if you compared our Lifetime Builder Elite, our Lifetime Builder Elite has a 100 basis point account value enhancement, so 1%. So to get that equal that same 1% in this example, they'd have to credit 6.67 to get the 1%. But the drawback to these is when your index performance is lower or 0, you get 0 because it is a multiple of whatever the index credit was. And then there is the additional cost, which is the most recent ones that have come out. It's an asset-based charge charged against that index account. So it takes the zero as your hero out of play. So if you think back to that example that I showed before with the red line below. So it's really important to understand when you're looking at products, when you're looking at an illustrated rate, because one of the things that I hear most commonly is, well, I use a conservative rate to illustrate my products. I illustrate everybody at a certain percentage. But the thing to understand is there's a difference between illustrated rate and credited rate. So I'm going to walk through an example here of a traditional IUL product and then 2 different multiplier products as examples using kind of in general terms how they work. I'm going to look at the illustrated rate. We'll look at the estimated credited rate through the first 25 years, and we'll look at the average asset-based charge through the first 25 years. So if you look at the cap rate, right, typically on a traditional IUL without multipliers, you're going to see a higher cap. The reason is just the way the product design is you're going to typically see that little bit higher cap there on a traditional IUL. So regardless of who that is, us, AIG, some of the other carriers out there who are still pretty strong in that non-multiplier market. But then you take into account whatever the illustrated rate is. The illustrated rate is dictated, so the max illustrated rate is dictated by AG 49, so Actuarial Guideline 49 specifies how a carrier calculates that. That's based on the cap and the floor that's offered. So within the traditional IUL, you've got a higher cap rate, so you have a higher max illustrated rate, right? Because you've got more capacity there. From 0 to 13.5 versus 0 to 9.25 or 9.5. So you can see the max illustrated rate. But when you look at the actual credited rates between these, so the traditional IUL, it has a 100 basis point account value enhancement. So you can see that reflected there, the actual average credited rate, 8.58, because you've got an additional 1% added to the account value every year. On the multiplier products, what you're seeing there is the bonus, so the bonus credit that's applied. So the average credited rate, even though you're illustrating at 5.76, The average credited rate in this example is 11.85. Over on the right, the average credited rate over the first 25 years was 12.09. So understanding the difference of what's actually credited there. The other thing you have to take into account is what's being charged. So what I'm not showing here is what's happening with the actual account value. So while there's 11.85 on average being credited, there's also on average 4.42% being deducted, or 4% on the right-hand side being deducted. So your net return on that, on the multiplier product number one, your net return ends up being about 7.5% net return after you take out that asset-based charge. So understanding that your client's paying to get that additional upside potential. So it actually, even though that credited rate looks very large, your actual net credited rate is much lower than what you see on the screen. So some things to remember about bonuses and multipliers is, number one, they provide more upside for your client. So when the market is, the index change is very great, they do very well for the client, but it does add additional risk. So it takes that additional, traditional IUL value proposition of upside potential, downside protection, and it still gives them downside protection. It's just now the downside is negative. Whereas before, the only negative was the policy charges and pieces in there that would deduct from the actual contract. So in a year that you get zero, everybody knows there's charges in a life insurance contract, so you'd still see your account value go down, but you're not getting a negative index return. Now with the account value, the asset-based charges in these multiplier products, you now have that potential for that negative on the downside. There's a cost to provide that multiplier. Almost everyone that's in the market today, it's an additional asset-based charge. The other thing to be aware of is other non-guaranteed elements. When you look at a contract, they may have a multiplier that's guaranteed based on an asset-based charge. They may also have a non-guaranteed additional credit that if the contract meets certain elements, that they will credit. You really have to look very closely at those. Most carriers today offer a report within their illustrations that will show you the account value, the credit for the index, the credit for whatever multiplier or bonus they have, the credit for any non-guaranteed elements, and the charge that's associated with that multiplier bonus. You really need to be aware of those other non-guaranteed portions, because those are the pieces that have a lot more variability to them. So you really want to make sure you understand and are looking at those different pieces. Within Global Atlantic's products, we'll talk about the accumulator IUL here in a minute. There's not a lot of additional moving pieces beyond the charge and the multiplier. So there's not additional non-guaranteed elements, other credits, performance credits that are applied as well. When you look at us from a competitive standpoint, this is looking at a 35-year-old paying to retirement, minimum non-max, so traditional, max funded scenario. We're Global Accumulator, which is our buy-up option. We have two different buy-ups. I'll walk through those here in a little bit, but very strong when you look at that accumulation and distribution. If we drop the illustrated rate down to 6%, our product moves up to the top of that grid. I see we've got some questions. Go ahead, Kyle.
Donald, I think I answered a couple of these individually, but maybe just briefly re-explain the relationship between the AG 49 kind of maximum illustrated rate, compared to what's actually being credited on the policy, particularly with multiplier products. We had several questions and I know you showed that, but maybe re-emphasize that point, kind of the difference between, you know, what AG 49 allows you to illustrate and then what's actually being credited on the policy in the illustration.
So within AG 49, AG 49 prescribes what your, you know, illustrated rates. When you look at a carrier's illustration or illustration software, it's always going to say, here's the max illustrated rate. And that max illustrated rate does not take into account any multipliers or bonuses. So that's just the base illustrated rate based on the cap rate, the participation rate, and the floor offered on that index. So that's what's going to drive it. And then it is a 25-year average going back 65 years. Now, that's a lot. I know I just said a lot just in those few words. So it's a mathematical formula that actually looks back 65 years using 25-year averages to come up with, if you applied that cap and that floor and that participation rate, what would that average be? That's what AG 49 has prescribed, and every carrier has to comply the same way. Now, there is another piece of the regulation that talks about a benchmark index. For Global Atlantic, S&P 500 is our benchmark index, and so is, it's the same for almost every carrier out there selling IUL. They're using the S&P 500 as their benchmark index to go back and measure that cap and floor and participation rate to calculate their maximum illustrated rate. So illustrated rate is the first function, because so when you calculate what's credited, so it's the whatever the index change is, then that's yours. So if you think of illustrated rate, that's kind of the first, you know, so this is your first index crediting rate before any multipliers are applied. Then once you have the initial crediting rate within the policy, then you apply your bonus rate, whatever that bonus rate may be. So if your bonus rate is, let's say your bonus rate is 50%, you know, so you've got a 50% bonus. So you would take your credited rate, so the 5.76 times 1.5, and that would equal the total credited rate for that year based on that bonus. But then the piece you have to take next is you have to subtract out whatever that charge was for that bonus. So if your charge, let's say for that 50% bonus, let's say your charge was 4.42%, or let's do easier math here. Sorry. Let's say it's 4%, and let's say your credited was 5.88. So when you take that 50%, in this example, you'd be looking at, say, 11.67% total credited, and then you'd have to subtract out your 4%. So you're looking at 7.67 would be your net crediting to the policy. And I think that's the piece that gets overlooked a lot when I talk with folks about multipliers and bonuses on products. When I talk to people about that, that's the piece that gets overlooked most often, is the charge and how that affects the net crediting to the policy. And it's really important to understand. You know, I don't want anybody to take this that I believe bonuses or multipliers are bad. I don't. I think they're the next step in innovation and product design for those clients that are comfortable taking that additional risk. But I think it's really important to understand what that risk is. You know, it's our jobs to educate clients on the vehicles that we're selling. If you've talked to me much, or if you've seen me present somewhere else, you've probably heard me talk about vehicles before. I just think it's a great way and a connection point, because you think about life insurance or other things in the financial services industry, we're selling vehicles. And we know what destination we're trying to get to. And life insurance is a vehicle. It's a vehicle to help them deal with different financial needs throughout their life. You know, the one that everybody always thinks about is the death benefit that's paid to beneficiaries. But you know, it's important to understand the features and benefits that are in that vehicle. When you're talking about multiplier products, you know, it's like a traditional index universal life is a really nice vehicle. You know, it's a nice car. It's got a lot of great features, a lot of safety features built in. And multiplier and bonus products are like taking that nice car with the nice six-cylinder engine, you know, and adding, you know, maybe adding turbo boost to it. So you've got the potential to go faster, but when you go faster, you're also taking additional risk. The other thing that happens is when you add that additional boost, it probably affects your overall, you know, mileage efficiency of the vehicle. So you've got additional costs because you're going to have to put more gas. You're going to have to refuel more often if you're using that turbo boost. And multiplier and bonus products are very similar. You have to watch those charges because if you're not getting the returns to support those charges can really pull down the account value. So it's important to understand those. Kyle, are there other questions beyond that there?
I think one of the questions that we got, and I think it's a good one, and I mean, I think there is some opinion in this, but I think the question was, you know, one of them was basically providing that, you know, he didn't see necessarily the benefit of the multiplier compared to a traditional IUL, you know, structure. So, you know, maybe talk a little bit about, you know, where one is better than the other, kind of from a performance standpoint, and then maybe talk about, you know, kind of setting that expectation up with the client, because I think that marries well with, you know, us as Global Atlantic has kind of both those options, both those products, both those stories. So kind of how do you decide which one's the best, and kind of where do each one, you know, where does each of those kind of product designs lend itself to the best performance?
Yeah, and I think that's a great question. And you know, it's really important to remember that there is no one size fits all for our client. You know, it's difficult to say that this one product is what everyone should have. And, you know, that's why there's different products in the marketplace. I used to say, you know, if all I have is a hammer, everything looks like a nail. And if you think about it, if you took your car into a mechanic and your mechanic only had a hammer, would you leave your car there? Well, no, you're not going to leave your car there, because how are they going to fix the car? It's the same thing when you think about what's offered within products. You know, looking for the variety within a portfolio that's going to offer solutions for your differing client needs, because different solutions and different client profiles call for different products. You know, and that's why within our product at Global Atlantic, we've tried to develop, you know, different solutions to meet different risk tolerances, as well as, you know, different scenarios for different purposes. You know, but it's important to make sure that, you know, you're thinking about client's risk tolerance, because a multiplier product can be a great product as long as the client understands and maybe has a little bit higher risk tolerance than, you know, somebody who's a little bit more conservative. Traditional IUL is going to be better. And it's hard to say that one is better than the other, because I think depending on the client is going to determine which one is the best. The asset-based charges definitely introduce the additional risk, but yeah, to say which one is better is really dependent on the client. I did want to kind of jump over to a little bit on our portfolio. I'll say here my my system has frozen, of course. Here we go. Because within the way we've built our multiplier products, I'll talk a little bit about it here, and as I can get my slides to advance, I will move that forward. But within our multiplier products, so Global Accumulator IUL, we built it what we believe is a smart way with the multipliers. So most multiplier products in the market today, they start charging their multipliers, they start charging the asset-based charge as early as the second year. So that asset-based charge starts hitting the account value right away, very early on in the contract. So the way that we tried to build our product with multipliers is to make our buy-up strategies or our multiplier strategies smart. And what I mean by that is we have kind of two different options for smart buy-up, and there's a different trigger for each one when that asset-based charge actually starts. So within our product, so within Global Accumulator, we still have the standard 1 year point to point. So you don't have to have a multiplier or a buy up within the product. So if your client is not comfortable with that additional downside risk, they don't have to be in that strategy. We still offer the standard 1 year point to point. But then we have our two buy up strategies or multiplier strategies that have an asset-based charge. And as we go through those, when we look at the first one, we call it Smart Buy-Up Secure. The reason why we call it secure is because we believe there's still some security. We've been able to mostly maintain that traditional IUL value proposition of zero is your hero. So we have a buy-up add-on charge, or the asset-based charge is 125 basis points, 1.25%. That also happens to be equal to the current account value enhancement rate. Now, if you remember what I talked about earlier, the account value enhancement is a straight flat percentage multiplied by the account value. So 1.25% times the account value is your account value enhancement rate. Your asset-based charge is 1.25% multiplied by the index account value. This buy-up or this additional bonus or multiplier doesn't start until the end of the 5th policy year. So beginning of the 6th year, which is also the same time the account value enhancement starts. So what we felt was what we're doing is giving the client the opportunity to basically use that account value enhancement to cover the asset-based charge to get an additional 25% buy-up add-on percentage. So we believe that it's smart because we're helping to maintain that zero is your hero, because the charge for the buy-up is offset by the account value enhancement. So we think that's pretty smart. We give them additional upside potential for that client that thinks the market's going to do pretty well. A 25% buy-up add-on is going to be better than just the account value enhancement. So I'm going to go with that option, right? So we've got something smart there. So that's for that client that's maybe wants a little bit more on the buy-up, but doesn't want the exposure of the larger asset-based charge. Our second buy-up or multiplier strategy is our Smart Buy-Up Performance. So the way that we built this one is the buy-up add-on percentage is 110%. So there's quite a bit of additional upside potential, but the charge is also much higher. It's 5.25%. Now remember, there's still the account value enhancement. So the account value enhancement of 125 basis points helps to offset some of that asset-based charge. And what's smart about this strategy is it doesn't actually start charging and getting the additional percentage until the account value is at least 20% of the face amount. The other thing that makes it smart is on the back end. If your client's taking distributions, that account value is going down. So that net account value is going down. And if that net account value drops below 20% of the face amount, we shut off the charge, and you don't get the buy-up add-on percentage anymore either, but we're not continuing to take that asset-based charge, which could increase the risk of lapse on the policy because of those additional charges. other carriers in the market. Nothing wrong with their design, but to understand is they charge early, regardless of what account value thresholds have been met, and later in the contract, it doesn't shut off to help protect the client in case of the account value dropping to a point where there's a risk of lapse. So we think that was a smarter way to build it. We've heard a lot of different feedback. Some people like it, some don't. We just felt we wanted to try and maintain the IUL value proposition as much as we could. But for those clients that wanted to take on that additional risk, wanted the potential for that additional performance, we wanted to provide that for them. So we did it in this way, trying to be as smart as possible. So when you think about kind of that cost benefit and thinking about your client risk profile, if they are very low risk, you can stick in the standard one-year point-to-point strategies without any buy-ups, without any additional asset-based charges. So that option is there for those clients. With the Smart Buy-Up Secure, we wait until the 6th policy year, the account value enhancement and the buy-up add-on charge rate, same percentage. You get an additional 25% of the index credits credited to the policy for that 125 basis point charge. And then on the right side, that performance, you still have the account value enhancement, buy-up add-on charge of 5.25%. So you're at about a net 4% on the charge. And then they get an additional 110% of the index credits. So if the index credits 10%, they're going to get an additional 11%. The total crediting to the policy is going to be 21%. So it's a nice potential for upside, but understanding the client is taking on additional risk that didn't used to be there. Some other things about our contract that's maybe a little bit different is we have a minimum interest rate guarantee of 2%. Our index interest rate is 0. You know, we talked a little bit about kind of that seat belts and airbags. So accelerated access rider on our products. You know, there's no upfront cost. It offers benefits for chronic and critical illness. Currently not available in California. I need to disclose that. And, you know, why would you use our product versus somebody else's? We think our buy-up strategies or our bonus strategies are smart in the way that we're offering them to help protect the client, not only on the front end of their contract, but also on the back end when cash values could be low. The account value enhancement that we have built into the contract is very strong. We have great accumulation potential, flexible options for, you know, accumulation, as well as some unique loan options. We have 3 different loan options. Don't really have time today to kind of get into those. And then we also have our patented Wellness for Life rider that we've had in the market. We were the first to introduce a wellness rider on life insurance contracts. We've had it in place for over 10 years. It's a very simple rider. They go to the doctor and they step on the scale. That's all they have to do to qualify, and do that every 2 years. So we can answer more questions about that at another time, because I know we've run over, and we're running up against the top of the hour almost. I did want to give a quick preview for next week. We'll have our advanced markets team on here talking about the review of the recent stimulus package. They're going to talk about that at 11 a.m. and then really dive deep into the Secure Act at 3 p.m. next Wednesday. Kyle, I think we've got a little bit of time here before the top of the hour. I think we've got about 3 minutes. Any other questions there?
Yeah, so I know we've gotten a lot of askings for the recording. We will get this recording converted to a file that we can send to you, and you'll get a follow-up email hopefully by the end of the day or early tomorrow with the recording of this. Also, you know, Donald mentioned next week's sessions. Also, don't forget today, if you're available, we have another IUL Marketplace, a 2-1 session where we'll dig a little bit deeper. So if you enjoyed this, there'll be some nice continuity of this kind of discussion at a little bit deeper level at 3 p.m. Central today. So definitely get registered for that and check that out. So one question that we got, Donald, and we kind of, it was at the beginning, but I do think that it kind of, people have a lot of questions on this, was when you were talking about the mortality tables, we got the question about how will coronavirus change this? And maybe you can provide a little bit of color in terms of kind of, you know, obviously we're using a CSO, mortality tables from 2017. So current product wouldn't change with that, but just give a little bit of an update on kind of obviously that point that it won't change the current cost of products, but maybe how Global Atlantic is kind of continuing business as is.
Yeah, so coronavirus has definitely introduced a lot of different questions for the industry in general. Not just life insurance, but just financial services in general. And, there's a lot of studies being done right now around mortality and how this may impact mortality tables. Anybody who knows me knows I'm a nerd. I wear it proudly on my sleeve. I'm a nerd who's been in sales for 20 plus years, but still a nerd. So I've been actually looking at some of the mortality studies that are going on right now, looking at, deaths as compared to projected deaths for total, all illnesses combined. And, right now, we're seeing fewer deaths in some other areas that coronavirus has definitely impacted. But, they do expect it to affect mortality, which could affect claims experience that is projected by carriers. But right now, everything that I'm reading is not seeing it to be a significant event for life insurance company mortality. Just because if you think about what I said a little bit earlier, we've basically seen a kind of a trade-off on where the deaths are coming from. I'm sorry, it's probably pretty morbid and looking at it, but I like to look at the statistics and the numbers behind things. But as what we've seen based on predicted deaths, we're running right at about where they were predicting deaths for 2020. It's just we're seeing them come from some different spots, and from different causes than what they were predicting. Coronavirus definitely has is still at a epidemic pandemic level. But it's just been a shift in where those predicted deaths were coming from. So there's still a lot to come as far as long-term mortality and how it may impact, future mortality table updates. So still a lot to come there. Still really, really early to really predict that. I think the biggest thing to watch right now is volatility in the market and interest rates. We want to see interest rates rise, and we want to see volatility continue to come down. That would really help kind of everyone in our industry, from a cap and participation rate standpoint, because as interest rates rise, it increases the, what we can offer from an option budget for what we can buy, within the option market. So as volatility drops and those option prices come down, it's kind of that perfect storm for all of us. So I don't know if I answered that specifically, Kyle.
I think that was really good. And there's a couple questions, but we'll send those out via email since we're at the top of the hour. We went long. So I do want to thank everyone for joining us today. Great participation, great numbers. If you want to go a little bit deeper today, join us at 3 p.m. Where we'll talk in more depth on this subject. As Donald mentioned, next week we have kind of a focus on advanced markets with the stimulus package. How does that affect the financial services industry and what opportunities could arise from there? And then the afternoon session will be on the Secure Act. So look for the registration emails for those coming out shortly. I want to thank Donald for his time. We really appreciate it. And again, thank everyone for joining us. Let us know if you have any questions, what we can do to help you out. We appreciate your partnership and your business. Have a great day.